So in this video, we're going to do a little overview of Chapter 7, which is all about cash and internal controls. So our learning objectives are to define internal controls, and we're going to look at the components of internal control and procedures. We're going to see how we apply internal controls to cash receipts and cash payments. That's important. We're going to look at how to record debit and credit card sales. And then finally, we're going to take a look at the importance of a bank reconciliation as a control device and the use of a bank. So internal controls are a company's plans and policies that are designed to safeguard the company's assets and ensure the reliability of its accounting records. If you've been to a movie theater, you might notice that the person selling you the tickets, of course you could buy them online also, but say the person sells you tickets, is not the same person that's going to collect the tickets when you enter the theater. That is a form of internal control to making sure that one person is not going to allow you to go in for free. So internal controls are designed to prevent fraud, like what we were just talking about, which would be letting someone go in for free, or stealing money from a company, and errors, which would be either mistakes in applying rules or making mistakes in recording transactions. The Sarbanes-Oxley Act of 2002 applies to all public companies that report to the SEC, so U.S. public companies, and it created some guidelines. This was a result of some very big frauds, the WorldCom and the Enron frauds that happened right before that. They wanted to create corporate executive accountability so that a CEO couldn't say, for example, oh, well, I didn't know what was in the financial statements. Develop internal control procedures, and we're going to see a new internal control audit report that came out of that, and then some rules around auditor and client relations. Here's an example of two different types of opinions that auditors will issue when they audit a company. The first one, this is a Lockheed Martin, and I chose this one because I'm familiar with this because someone I know was auditing this company when it was happening. This is back from December 2016 and 2015. The black part is the financial statement audit opinion. So they're looking at the financial statements to make sure that they present fairly the results of the company. And then they have a opinion, another audit opinion report on the company's internal controls. So in this particular case, the reason that it's interesting is that they expressed an adverse opinion on internal controls, which is the worst kind of opinion that a company could have. And this was pretty bad. It basically means that they had no internal controls. And that causes the auditors a lot of trouble because they can't rely on those internal controls when they are performing their audit. Let's take a look at some common internal controls. So one very common one and very important one is called segregation of duties. And that was what I was talking about when I talked about the theater. So what this says is that access to the assets and recording the financial information about those assets should be separated. So an example of this is person operating the cash register should not be the person recording the cash received in the accounting records. This prevents someone from taking cash and then altering the records as a result. Electronic devices, you're probably familiar with, little tags they put on the clothes when you're in a clothing store if something's expensive, right? On your way out, it will beep if the device is not removed, and that provides physical security over things like merchandise inventory. Paying good salaries. So these are ways to find competent, reliable, and ethical personnel. Paying good salaries, training your employees to make sure that they know what the controls are in the company and the rules and how to follow them, and then also supervising the employees. Documents are important. I'm sure you're familiar with a pre-numbered document. Can you think of one? So checks are pre-numbered documents. I'm sure you've seen a check. I know we don't really use them that much anymore personally, but they still exist. They're pre-numbered, and that means that if you have, say, checks 1 through 300, somebody can look and make sure that the checks were all accounted for, so there's no missing check. So the pre-numbering helps with that. E-commerce controls are things like encryption and firewalls, making sure that no one has unauthorized access to the company's records. So there are also some limitations on internal controls. For example, you can't turn a bad employee into a good one by implementing internal controls. Collusion is a big problem. That is a big drawback. And what that means is that 2 or more people acting together can get around internal control. So if we go back to the theater example, if the 2 people working at the theater were working together, one can say, hey, can you please let my friend in? And if they work together, then they can override the internal controls. Top-level employees, they might be the ones that have created these internal controls. They might know how to override them, and they have the opportunity to commit fraud. And also remember that having effective internal controls does not mean that the company is going to be successful, right? It means that it helps to safeguard the assets and ensure the reliability of the accounting records. So let's take a look at internal controls over cash receipts. This diagram is also in your textbook. In this example, the company is receiving checks in the mail. And the person in the mailroom opens the mail, and they make sure that the check and the remittance advice match. Now, you probably, if you've ever paid a bill, you might have seen, for example, doctor bills have this. If you have a doctor's bill, there'll be a bill, and then at the bottom it'll say, tear off this part and send it in with your check. And that's what a remittance advice looks like. So maybe you say, okay, here's my check for $50, and on the remittance advice you write amount sent in was $50. So these 2 things take different paths, and they provide a check on each other. And notice that the person that has the actual money is not the same person that is recording the money. And then at the end it can be checked. Now, internal controls over cash payments generally, let me go back to this 1 minute. I wanted to mention internal controls over cash receipts when you have actual cash. This is checks. But there are some companies that still receive cash money, right? We don't use a lot of cash these days, but there are some companies that receive cash. I like to go and my husband and I go and buy bagels every Friday morning. And when we go to buy bagels, we pay cash. Or whichever one of us goes to buy the bagels, we'll pay cash usually because it's a small amount of money. And so the bagel store gets a decent amount of cash. The internal controls over that are, generally, if maybe you've worked in a retail store, like a CVS or a Target or something like that. Maybe you have control over the cash register, right? The cash register is an internal control because it's holding the money. It is keeping track of the money that comes in. It's giving people a receipt. And then at the end of the day, someone other than the cashier is comparing what's in the cash register to what was supposed to be there based on the receipts, right? And then someone else would be recording the money. Another internal control over actual cash would be to make sure that the cash is deposited at least daily, right? You don't want to have cash lying around. All right, let's take a look at cash payments. So in this example, the company is buying merchandise inventory, and there's going to be an authorized signer. So each company has particular people that are authorized to sign checks. Of course, I cannot sign checks for the college where I work, right? I'm not allowed to do that, and you may work for a company where you're not allowed to sign checks. So the authorized signer would be the person that actually signs the checks, and then they check the supporting evidence to make sure that this is a legitimate business payment. In the case of inventory, they want to make sure that, number one, the inventory was ordered by the company, so they issued a purchase order. The inventory was received, and that all of these match. So the invoice matches the amount of inventory that they ordered, and then the amount of inventory, the amount of the bill, the invoice, matches the check. And so all of that will be checked, and then of course making sure that the inventory was actually received at the company. So all of this is checked by the person before they sign the check. All right, now many companies use debit and credit cards. There are some very good things that come out as a result of that, right? The company reduces its risk because they don't have to worry about collecting the cash from their customers, and they do pay a percentage for that, accepting that risk. The credit card company accepts the risk, right? Because the person using the credit card has to pay them. So over 65% of retail sales in the U.S. are done with either a debit or a credit card. That's a couple of years ago, so it might be even more now. So some of the control procedures are using point of sale terminals that have particular security. Remember, one of the things that you have to do with credit and debit cards is you have to protect the customer's information. So you want to make sure that no one can get access to that credit card information. Never print the full card number. Once in a while, if I have to call somebody and give them a credit card for some reason, I will say to them, what are you doing with that when you're done with it? And I want to make sure that they're going to shred it. Doesn't happen very often, but I also do that anytime someone has to write down my social security number, by the way. Make sure employees are trained on appropriate procedures so that they don't inadvertently give away a customer's credit card, say by printing something and then just throwing it in the garbage. Make sure that refunds are processed by someone other than the person processing the sale. And then finally, everything is going to be the data is going to be encrypted behind a firewall. So again, access to that information is limited. So let's take a look at recording debit and credit card sales. There's two different methods. Let's say that Sparkle and Shine cleans some windows for local businesses for $1,000, and then the customers pay with credit cards. Sparkle and Shine, the company, pays 3% to the credit card company. All right, so this is the net method. So in this method, we record the cash for the amount of the revenue, which is $1,000, less the credit card expense, which is 3%. And everything is recorded all at once in one entry, and most likely what the company sees on its bank account, and its bank account is a deposit of $970. The alternative is a gross method, which would be where you record the sale at its gross amount, so you record the whole $1,000, and then later you record the credit card expense. So notice that it doesn't matter which way you record it, the results are the same. You still have $1,000 of service revenue, you still have a $30 credit card expense, and you end up with $970 in cash. All right, so let's mention the use of a bank and take a look at a bank reconciliation. A bank is, of course, a very good way to keep your money safe, and the bank kindly keeps track of what comes in and goes out. So you have two records of everything that happened. You record it in your books, you record your debits and credits to cash, the company, and then the bank records the information. So at the end of a month, the company every month should do a bank reconciliation and make sure that the numbers in the bank agree with the numbers from on the company's books. So let's take a look at this bank statement. You may have seen one, probably online. Generally, we don't get paper bank statements anymore. But it shows the beginning balance, the total deposits for the month, the total withdrawals, a service charge, and then the ending balance. And then down here you see all of the details. So there were 3 individual deposits were made on different dates. A customer sent money directly to the account, an EFT, which is electronic funds transfer, and then the company earned $30 on its balance. The company, as we mentioned before, spent $20 on service charges this month, and then they wrote all of these checks. So they wrote 1, 2, 3, 4, 5 checks, and those were the amounts of the checks. Finally, they have 2 other deductions. They have waterworks, which means that probably their water bill was paid directly out of their account, which happens a lot these days. And then an NSF check means that a customer wrote a check to the company and then they didn't have enough money in their account, so their check bounced. So that means that customer still owes us the money, still owes the company the money. Now, I mentioned a bank reconciliation. There is a separate video that I have about bank reconciliations and one also about NSF checks. But let's take a look at this particular bank reconciliation here. Let's notice a few things. It has a heading, 3-part heading, so the person reading it knows exactly what it is. Notice that at the bottom, like a balance sheet, these numbers have to agree. So the adjusted bank balance has to be equal to the adjusted book balance. Now, the bank, everything that's here on the bank side are all of the items recorded on the books, but not yet by the bank. So there's timing differences. These are timing differences. Eventually, everything is going to equal out. But for right now, the company made a deposit, but the bank hasn't recorded it yet. So that's called a deposit in transit. Also, the company wrote a check, but the check hasn't cleared the bank yet. So that's called an outstanding check. So those things are adjusted on the bank side. Those are the 2 things that the company recorded on its books, but the bank has not yet recorded it. Then on the book side are all of the things that the bank recorded, but those things have not yet been recorded on the books. So remember, the company got its bank statement and it found out, oh, they put $100 in there for a customer that a customer sent in. We earned some interest revenue, so they add that money into their cash balance. And then they found out there's a service charge. They paid their water bill of $40 and their customer's check of $1,200 was not paid. So in the end, they add in the items that were increased their cash and subtract the items that decreased their cash, and they end up with equal balances here. Everything that's here on the book side is going to require a journal entry. So for example, this is going to be a debit to accounts credit to accounts receivable and a debit to cash. Everything up here will be a debit to cash. Everything down here will be a credit to cash, right? But if you got money from a customer, debit cash, credit accounts receivable. If you earned revenue, debit cash, credit interest revenue. And each item, these will all be credits to cash. The NSF check is going to be recorded as a debit to accounts receivable, because remember, that customer paid us, but now they still owe us the money. Okay? All right. So go ahead and take a look at the bank reconciliation video and the NSF check video, and that will help you finish up this chapter. Okay, see you next time.